Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Now, whether you are a newbie or an experienced trader, you have a lot to learn from this channel. In this video, we are going to be looking at something quite interesting. We're going to be talking about signs that can indicate that price of an asset is about to reverse. Okay, now the forex market is unpredictable, but if you know what to look for, you can spot potential reversals before they happen, right? So in this video, I'll break down 5 clear and obvious signs that forex market prices might reverse so you can stay ahead of the game. Watch until the end to see examples of these signals. And if you're serious about forex trading, hit that like button, subscribe, and turn on notifications so you don't miss my next trading breakdown. All right, let's just jump into it. The first clear and obvious sign of a market reversal is divergence. Okay, this happens when price action is moving in one direction, but your indicator is showing the opposite signal. It's like a warning sign that the current trend might be losing strength. For example, I'm going to add the RSI to the chart. The relative strength index is one of the indicators that traders use for spotting divergence. Another indicator is the moving average convergence divergence, or the MACD for short. Another is the stochastic oscillator, right? But in this video, I'm just going to be using the RSI. Okay. So take for example, if you have price making higher highs, okay, let me look for a very good example. This is more of a double top. This is a double top pattern, not a higher high. Okay, so if you have price making higher highs, right, like what we see here, but your RSI is making lower highs, that's what we call a bearish divergence. Okay, it signals a possible trend reversal to the downside, and you can see that we actually had a trend reversal to the downside, right? The same applies in reverse. If price is making lower lows, let's just see if we can find that. If price is making lower lows but your indicator is making higher lows, it's called a bullish divergence. In that situation, it's called a bullish divergence. All right, you can see that happening here. This price was making lower lows here, and you can see that we had higher lows. So I can see that eventually we had a reversal to the upside. So this is what we call a bullish divergence. Okay, now let's talk about support and resistance levels. These are price zones where the market has historically reversed multiple times. All right, if price approaches a strong resistance level and fails to break through, chances are we might see a reversal to the downside. The same applies when price bounces off a strong support level, indicating a potential reversal to the upside, right? Now, one major mistake traders make is assuming price will break through a level just because it touched it multiple times. Instead, always look for confirmation like rejection candles or reduced momentum before making a move. All right, it is very, very important. Now, candlestick patterns are another great tool for spotting reversals early. There are 3 key patterns that you should be looking out for. The first is the engulfing pattern, right? The engulfing pattern, this is an example what we had here. Engulfing pattern is a strong reversal signal where a big candle fully engulfs the previous one, indicating a shift in momentum. Then another candle that you should be watching out for is the doji candle. The doji candle, this is an example of a doji. You can see what we have here. A doji candle is a small bodied candle with long wicks showing indecision in the market, often appearing before a trend change. And you can see that that's exactly what happened here. It appeared right before the trend changed from a bullish trend to a bearish trend. All right. Then the next candlestick pattern you should be looking out for is the pin bar. The pin bar is a candle with a long wick and a small body, signaling strong rejection at a key price. So a pin bar usually occurs around resistance or support zones. I'm trying to look for a very good example. I'm trying to look for a very good example. Okay, I think we had a sort of a pin bar here. I think we have a pin bar around here. Yeah, because the pin bar usually have a long wick and a small body. But in this case, the body is not usually in the middle, all right? Because it's trying to show you rejection. That's the reason why it's called a rejection candle. It's showing you rejection. You can see that I have a long wick on top and a small body below. So price initially got all the way up here, but it was rejected. And sellers pushed the price down. Okay? So after that, you can see that we actually had a sell. Now, these patterns, the engulfing, the doji, and the pin bar, they work even better when combined with support and resistance or divergence. All right. So it's important to, use them alongside each other. Now, volume is like the fuel behind price movement. A sudden spike in volume at a key level can signal a potential reversal. Why? Because it shows that big players are stepping in to push the market in the opposite direction. All right. So because of that, you can add the volumes indicator to your chart if you want to watch out for volume spikes. Okay. For example, if the market is in an uptrend, but suddenly a huge volume spike appears as price rejects a resistance. Had it been we had something like that, in this case we didn't exactly have a volume spike per se, but if you have a volume spike when price is getting rejected around a resistance, it could mean that sellers are taking control, leading to a downtrend. Right? Volume confirms whether a reversal is real or just a fake out, so always pay attention to it. Finally, we have trend line breaks. All right, if price has been respecting a trend line for a while and suddenly breaks through, that's a major sign of a potential reversal, like what we can see happening around here. Okay, for example, if the market has been in an uptrend, you can see we had an uptrend here, right? We had an uptrend, and then finally price breaks below the upward trend line. It could signal the start of a downtrend, and you can see that we actually had a downtrend after that break. All right, but remember, always wait for a retest of the broken trend line. Can you see that we actually had a retest, kind of, even though that I didn't exactly get to the breakout level, but we had kind of a retest before the continuation, and the continuation was even validated by this bearish engulfing pattern. All right, so it's important to get confirmations before you enter your trade. Okay, now let's just do a quick recap. The 5 clear obvious signs that forex market prices might reverse are: 1, divergence, okay, which is when price moves opposite to indicators. The second is your support and resistance. All right, your resistance and support levels. Okay, the third is candlestick patterns. All right, engulfing candles, pin bars, dojis, and the rest of them. Then the fourth is the volume spikes. Right, you can see that here we had a volume spike aligned with this bearish engulfing, showing that this sell move was valid. And then finally, the fifth is the trend line breaks. Breaking a strong trend line signals a potential reversal. Now I want to hear from you. Which of these reversal signs do you use the most? Drop a comment below and let us discuss. And before you go, don't forget to hit that like button, subscribe, and turn on the notification bell so you never miss a new video. In the meantime, thank you for watching and happy trading.